When it comes to investing, Warren Buffett is widely regarded as one of the greatest minds in the world. His strategies and principles have earned him a fortune of over $100 billion, making him one of the richest people on the planet. Yet, despite his unmatched success in stocks, there's something curious about his approach. Buffett doesn't invest in real estate. Sure, he owns a modest house in Omaha, Nebraska, where he's lived since 1958, but unlike many wealthy individuals, he hasn't built his fortune through real estate holdings. This raises a critical question. Why does Warren Buffett avoid the real estate market? And more importantly, should you be cautious about investing in real estate, especially with concerns about a potential housing crash in 2025? Today, we'll explore these questions in depth. By the end of this video, you'll have a clearer understanding of why real estate might not be the golden ticket to wealth that many believe it to be. If you're serious about building wealth and investing, grab a pen and paper because you'll want to take notes on this one. We're going to break down Buffett's reasoning into simple, clear points, backed by real-life examples and actionable insights. Buffett's first reason: real estate requires too much time and effort. One of the primary reasons Buffett avoids real estate is that managing property isn't a passive investment. It's a business. Unlike stocks, where you can buy shares and let your money work for you, real estate often requires hands-on management. Think about it. Owning one rental property might seem manageable, but once you scale up to multiple properties, you're essentially running a full-time business. You'll need to deal with tenants, maintenance issues, and potential vacancies. And even if you hire a property management company, you still need to oversee them and handle major decisions. Imagine you own 10 rental properties. Over the course of a year, you might face broken appliances, leaky roofs, and tenant disputes. Each of these issues takes time to resolve, pulling your focus away from other opportunities. Buffett has always been clear about the value of time. He prefers to spend his time analyzing companies and making investments that require minimal ongoing effort. For him, the opportunity cost of getting into real estate is simply too high. If you're thinking about getting into real estate, ask yourself, do you have the time and energy to manage a business on top of your current commitments? If not, it might be worth reconsidering. Buffett's second reason: it's harder to find great deals in real estate. Buffett's investment strategy revolves around finding undervalued assets, companies with solid fundamentals that the market has overlooked. He buys these assets at a discount and holds them for the long term. In the stock market, opportunities to buy undervalued assets pop up frequently, especially during periods of market volatility. But in real estate, great deals are much harder to come by. Why? Because the real estate market isn't as liquid or transparent as the stock market. Let's say there's a property in a desirable neighborhood listed at a significant discount. Before you even hear about it, local real estate agents and investors have likely already jumped on the opportunity. Unlike stocks, where anyone can see the price of a company in real time, real estate deals are often closed behind the scenes. Additionally, finding a truly undervalued property requires deep knowledge of the local market. You need to understand zoning laws, rental demand, and potential development plans, things that aren't always obvious to the average investor. Buffett's third reason: real estate doesn't scale as easily as businesses. One of the biggest advantages of investing in businesses is that they can scale infinitely. A successful company can expand its operations, enter new markets, and increase its revenue exponentially. In contrast, real estate is limited by physical space. For example, when Buffett invested $36 billion in Apple in 2018, the company continued to grow, and his stake is now worth over $160 billion. Additionally, he receives regular dividends from Apple, totaling hundreds of millions of dollars annually. Real estate, on the other hand, has limitations. Even if you own a prime property, there's a cap on how much rent you can charge and how much the property can appreciate. This doesn't mean real estate is a bad investment. It simply means that it lacks the scalability of other asset classes. If you're aiming for exponential growth, businesses and stocks offer more potential. Buffett's fourth reason: there's more money in the stock market. Another key reason Buffett avoids real estate is that the stock market is significantly larger than the real estate market. As of 2021, the U.S. real estate market was valued at around $3.7 trillion, while the stock market was worth over $93 trillion. This means there are simply more opportunities to make money in stocks. Take a look at the world's richest people. None of them made their fortunes solely through real estate. Instead, they built businesses or invested in companies. Even the richest real estate investors, like Hong Kong's Li Shaoqi, have net worths that pale in comparison to tech billionaires like Elon Musk or Jeff Bezos. Now that we've covered Buffett's reasons for avoiding real estate, let's talk about why 2025 might not be the best time to invest in the housing market. Economists and analysts have been warning about a potential housing crash due to several factors. Rising interest rates. As interest rates increase, borrowing becomes more expensive. This reduces demand for homes, which can lead to a decline in property prices. Overvaluation. In many cities, home prices have skyrocketed over the past few years, far outpacing wage growth. This has led to concerns that the market is in a bubble. Economic uncertainty. With the global economy facing potential headwinds, including inflation and geopolitical tensions, the real estate market could be in for a rough ride. For example, during the 2008 financial crisis, home prices in some areas dropped by over 50%. Many investors who bought properties at the peak of the market were left holding assets worth far less than their purchase price. If a similar scenario plays out in 2025, those heavily invested in real estate could face significant losses. But while Buffett's approach makes sense for him, it doesn't mean real estate is a bad investment for everyone. In fact, many people have built significant wealth through property. The key is to approach real estate with the right mindset. Treat it like a business. If you're going to invest in real estate, be prepared to put in the time and effort to manage it properly. Do your research. Understand the local market, identify undervalued properties, and have a clear plan for generating income. Be prepared for downturns. Real estate markets can be cyclical, so it's important to have a financial cushion to weather potential downturns. While you don't have to follow Buffett's strategy exactly, there's a lot to learn from his approach. He's a master at identifying undervalued assets, thinking long-term, and avoiding hype-driven investments. If you're considering real estate, ask yourself, are you prepared to treat it like a business? Do you have the time, knowledge, and resources to succeed? If the answer is no, it might be better to focus on other investment opportunities. Remember, the goal isn't just to invest, it's to invest wisely. As Buffett himself once said, the most important investment you can make is in yourself. So, before you jump into the real estate market, take the time to educate yourself, weigh your options, and make informed decisions. For any questions, write to me in the comments, and I will be happy to answer you. See you soon.